Some troubling shockwaves are coming from China, and experts worldwide are trying to understand what's happening with China's economy. China experienced a lightning-fast economic policy mix-up these last 2 years. China's government has gripped tight on the markets, including the Chinese private sector corporations. Xi Jinping, the president of the People's Republic of China, chose to take matters into his own hands and decided to force the market into submission. China's reputation as the fastest and most aggressively expanding economy is about to burst. As more time passes, we're about to understand more and more how the recent domestic policy disturbances, China's zero-COVID policy, and the geopolitical stage worldwide has set up the perfect storm. But to what extent is Xi's China under severe financial trouble? Just how bad are China's economic woes? And what are the key indicators that have investors worldwide in a panic? In this video, we'll break down how China got into this mess in the first place, and help give you an idea of where the Chinese economy is headed. There are some profound implications for Chinese politics, foreign policy, and escalating global tensions. So sit tight and hang on, because we're diving deep into one of 2022's most ominous indicators of a possible worldwide economic collapse. So be sure to like and subscribe to the channel, and hit that notification bell so you don't miss a beat on these rapidly changing economic times. How did this happen? A campaign Xi ran on was the idea of common prosperity. China is experiencing a rapid imbalance in wealth and social classes. There is a rising inequality that has many citizens concerned. China responded to this crisis by closely placing its private sectors, such as big tech, under its watch. The party is firmly monitoring even the ultra-wealthy in China. This crackdown on large tech platforms started in mid-2021. Beijing's level of interference depended on the company's outsized market power. This action intended to regulate the market cost. All this was going on at the same time that Chinese financial authorities attempted to manage the assets of China. Evergrande Group, one of the shady real estate developers that contributed more than $300 billion in debt. This debt is consequential because property and real estate sales have dropped to an all-time low. This means that China has mountains of debt that are not generating any income. China's heavily indebted property sector represents about 29% of China's GDP. Quick crash course. Business investment confidence is at a record low. Consumer demand and exploding inflation have tied China's hands behind its back. Zero-COVID policy across many of China's metropolitan urban centers were ghost towns. China shut down factories and locked its population inside. This huge mess that we see in China is primarily self-inflicted. Whether or not Xi Jinping can reverse the damage his party has inflicted is yet to be seen. Domestic and overseas, the Russo-Ukrainian conflict exacerbated and slowed growth, and the folly of the pandemic management. Whether or not Xi will claim victory at the Chinese Communist Party's 20th Party Congress in November will depend on an economic rebound. But to truly understand what's going on and where China is heading, we should first review some data about the state of China's economy. China's struggling economy. Data from the National Bureau of Statistics showed that China's official GDP for the first quarter of 2022 expanded by almost 5%. Amazing, right? Well, don't start celebrating just yet. We should take these data with a grain of salt, or even a bag of salt for that matter. For starters, the data is not consistent with the official monthly data collected for the quarter. We run into even more inconsistencies when we compare the quarter-on-quarter terms from Q4 of 2021 and Q1 of 2022. The comparison reveals that China's GDP only grew a mere 1.3%. That's what happens when the state has such overreaching authority in books. And when we went even further back, in Q3 to Q4 in 2021, we saw a slowdown from a 1.6% increase. These data also suggest that the 1.3% increase in GDP in the first quarter was only represented in the first 2 months of the year if there was a solid increase. The Chinese government is downplaying the extent of the zero-COVID policy on the economy, citing the disturbances from COVID-19 lockdowns and the Russia-Ukrainian war. The International Monetary Fund, or IMF, has cut its annual growth forecast for China to 4.4%. This is the second downgrade in 3 months. That seems to be the trend, as private banks are even more doubting. When asked about the extent of the damages lockdowns had on the Chinese economy, Nomura Holdings Inc., a Japanese financial company, responded with a warning that China's zero-COVID policy could topple the growth even further this year. They're saying perhaps even by 3.9%. Some other painful points come from the manufacturing data. Purchasing manager indexes showed the factory and service sector falling to record lows since the pandemic start. This trend has gone on for 2 consecutive months. You'll need some heavy rose-tinted glasses to reach any positive picture of China's economy. What's slowing economic growth in China? A collapsing confidence for investors. China's private sector has taken a hard hit thanks to the fixed capital investment. Private investor confidence was already low at the start of 2022. The Chinese government is acting swiftly to combat the reckless expansion of capital. This added pressure is stacked on top of an already suffering market. You could imagine the devastating consequences of putting a cap on the market, but fortunately you don't have to. JP Chase has done all the work for you. JP Chase has downgraded almost 30 Chinese tech stocks in March this year. Some of the more prominent names on that list that they deemed uninvestable were Alibaba and Tencent Holdings. After that press release, confidence in the market took a free fall after the announcement. Losses were to be in the $2 trillion range. Lack of private consumption. China is experiencing problems in many areas of its economy, but one significant factor is the lack of private consumption. That's because, for the better part of the last 2 years, China's population has been locked inside due to what some are calling draconian measures. China's zero-COVID policy was one of the harshest lockdowns seen around the world. Experts at Nomura stated that over 373 million people in over 45 cities, about a third of Chinese population or more than the entirety of the United States, are still under restrictive lockdowns. This is costing China more than $7 trillion annually in GDP, skyrocketing unemployment. China is also taking a hit in rising unemployment. China is at a 2-year high in unemployment, reaching 6%, surpassing the annual target set by the Chinese government of the predicted 5.5%. China's new jobs created fell by almost 20%. These problems are not individual factors. Instead, they are contributing factors that worsen the effect of the economy. Without investment, you don't have credit. Without credit, you can't buy. Without a job, you don't earn money, and it makes it much harder to buy and sell when you're locked inside your home. The war in Ukraine. One way or another, the war in Ukraine is affecting the lives of everyone around the world. This war is affecting both commodity prices of goods and capital flow to China. China is in a tight position, almost having to back Russia's expansionist ambitions. As a result, investors are flocking from China in unprecedented numbers. Raw materials and resources such as energy and iron have hit record high costs. China is connected and dependent on these critical commodities as one of the leading juggernaut economies in the world, not to mention the largest producer of manufactured goods. Rising energy costs and choke points for raw materials are very problematic for China, as they are the world's largest importer of petroleum. The growth of an economy is directly correlated to the consumption of petroleum. An economy cannot expand without cheap oil. The situation doesn't seem to get any better as time progresses. Well, not according to Chinese propaganda. Perhaps a lot of China's woes were self-inflicted wounds, such as poor policy choices by Xi Jinping. But the economic turbulence happening right now isn't unique to China. Many countries worldwide are bracing for some of the most challenging times yet to come. What do you think? Is an economic collapse inevitable in China? Or will this blow over and be a lesson for future leaders to take note of? Let us know what you think in the comments below. And thanks for tuning in and watching. We've got a lot more great content coming your way. And trust us, you won't want to miss this.